Hi, today's topic of discussion is diversifying your portfolio through international funds. The demand for investing into foreign equities has peaked in the last couple of years, and there has been significant interest from investors to diversify their portfolio outside of the Indian market as well. Generally, for an investor to do this directly, one must open a brokerage account and be compliant with a lot of FEMA regulations, which is foreign exchange management. So in order to simplify things, a lot of the asset management companies have come up with a solution, which are called international funds, which come under the category of mutual funds. These are simply called international funds or feeder funds. The way they are made a lot simpler is that one does not require to open a brokerage account or anything of the sort. The process of investing into mutual funds remains absolutely the same. One simply must have a bank account and have a KYC in place in order to invest into these funds. Now let's understand what are international funds. These international funds are a combination of a lot of blue chip equity funds from foreign markets that are clubbed together in the portfolio of these funds, and one can simply go into the portfolio and scheme information document to identify into what proportion these stocks are being held. The advantages of using this vehicle to invest into foreign funds is the simplicity primarily. The simplicity basically means that one can invest into foreign funds by investing through your own local currency. So for example, if I was to invest into a US feeder fund, which would comprise of stocks such as Apple, Amazon, Netflix, etc., I could do that by simply investing through my current savings account in a rupee denomination and not having to open a brokerage account and then further incur a currency exchange and then make a purchase. Over here, it's as simple as making a purchase out of your account. So that is the primary reason. The secondary reason, by investing into these funds, one is also diversifying the portfolio outside of the domestic market. For example, if I was to invest into 2 or 3 large cap stocks in India, we know that there is a high correlation between these funds. The correlation could be something as high as 40 to 50% of the same stocks being held, even though I'm investing into 2 separate mutual funds. Once we invest into international equities, we reduce the correlation of stocks held in our portfolio and actually diversify the stocks that we have invested into. Therefore, this provides a very nice way of diversifying a portfolio across global markets. So one can choose something such as a US feeder fund, a European feeder fund, Chinese feeder fund, depending on what the investor feels the highest growth rate could be and the maximum potential of growth can be from these economies. That, for example, in India, certain sectors will face a cyclical nature, but the same cycle will not be followed by a foreign economy. Therefore, one investment in India may be catching a down cycle, but if you've invested into a foreign economy, and that may be facing an up cycle. So we can create a little bit more of a balance in terms of our returns and more stability in the portfolio by diversifying our investments. Now this brings us to the risk. Investing into equities across the globe carries the same types of risk altogether, but an additional risk by investing into these foreign funds is the risk of currency fluctuation. To explain this a little better, for example, if I am sitting in India today and I'm investing into a US feeder fund, where we know the stocks are such as Facebook, Apple, Netflix, and we know that my rupee is being eventually invested against the dollar. If there is a currency appreciation of the rupee, I know that my net asset value of this fund will take a slight hit, and vice versa. In case the dollar value goes up and the rupee devalues slightly, I will see an appreciation in my NAV. So the fluctuation can go either way, but it would be a risk that one should keep an eye out for. Now this brings us to the taxability of these funds. Now, because these feeder funds are treated as debt funds, this basically means that the short-term and long-term holding in such funds is 36 months. Which means that if one withdraws an investment prior to 36 months, you are charged as per your tax slab rate, And in case you withdraw these funds pursuant to 36 months, you will face a flat 20% rate of tax on your capital gains with your indexation benefit. So to conclude, in order to diversify your portfolio and reduce the correlation of stocks held in your portfolio, one can definitely consider investing into feeder funds.